Hello and welcome to another video. Everything that you can touch and that you physically own, such as the clothes that you're wearing and the car that you drive, can be broken down into their raw materials. These raw materials, such as cotton and aluminium, can be grouped together to be called commodities. And these commodities, quite literally, are the building blocks of modern finance. So let's check out how they work. Before we get started with the video, please make sure that you like this video and subscribe so you don't miss out on any further videos. Commodities are the raw materials that go into everything that we own or touch. We rarely think about these raw materials that go into the everyday objects that we use. However, they do start somewhere. And these commodities, like other financial assets, are traded on stock exchanges and owned by large financial institutions. What is a commodity? A commodity is a good used in commerce, which has little differentiation with other goods of the same type, where it doesn't matter who produced them or where they are from. For example, one of the most popular commodities is gold. And once it's transformed into the finished product, there is little regard from where that gold came from or who produced it. It doesn't matter if that gold is produced from the same quality as from a mine in Russia, South Africa, or America. In general, commodities can be broken down into three main categories: energy, precious and industrious metals, and agriculture. Energy commodities are anything that we use to provide power, from turning on and off the lights to driving our cars. These are normally oil, gas, and coal, because these provide physical goods that can be delivered to power our homes and our vehicles. The next category is precious and industrious metals. As the name suggests, these include precious metals such as gold and silver, and industrial metals which are used in commerce, such as iron and steel. And finally, we have agriculture, and this is anything that we eat. This goes from corn to soybeans to livestock such as cattle or pork. Determining the size of the commodity market is incredibly difficult, because whilst some of the larger commodities such as oil and gold are traded on formal exchanges, other smaller commodities are traded between parties. However, to put it into perspective, the largest commodity traded is oil, and that represents $1.7 trillion traded every single year, which is larger than all other commodities combined. When thinking of the buyers of commodities, these are normally institutions that take these raw materials and turn them into some sort of finished goods, which are more useful for users to produce something. The way in which the price of commodities change can be extremely complicated, because there is not only the supply and demand dynamic, there is also other factors such as the weather or natural disasters, as well as man-made factors such as political instability or tariffs. An example for how the price of a commodity can change: if there's an oversupply of the commodity, such as state sponsoring with steel, then it can push the price down. However, if there's an undersupply, such as a particularly wet year that affects crop yields, then the price of that commodity can go up. The price of the underlying commodity actually matters more than you might think. Because everything that we own comes from the pricing of a commodity, then that ultimate price difference, should the price go up or down, is passed on to the consumer, such as you and I. An everyday example of this is the price of oil, which can be vastly affected by wars in the Middle East or trade tensions between other countries of the world. This can directly affect how much money it costs to fill up our cars or how much it costs for us to go on holiday, as it influences the prices of plane tickets. A good way to think about how the price of a commodity can impact our daily lives is if the price of the oil goes down, it's cheaper to fill up your car, which means that you are more likely to fill up your car more often, as you're more likely to travel further and drive to places that you wouldn't have necessarily driven to. This is also the same for how the price of oil affects plane tickets. If the plane tickets are cheaper, you're more likely to travel and therefore more likely to go on holiday more often. And this chain of events can work the same way if the price of a commodity goes up as well as down, and this shows how a commodity can influence the wider economy. There are many different ways in which a professional and an individual can buy into commodities. The first and most obvious way is for the physical delivery of the commodity. As you can imagine, the physical delivery is only for a certain type of investor, as it's not really practical for an individual, as you don't really want to be loaded with tens or not thousands of barrels of oil rolling up to your house, as you can't really do anything with barrels of crude oil. Physical delivery for these commodities is normally done by companies who can change the raw material into a finished good, such as grain, and turn it into pasta. This is normally done using things called futures contracts. This is locking in a price today for delivery in the future. This is used by airlines and farmers so they can lock in a price and guarantee that price irrespective of how the price of fuel or the price of grain changes over time. The next way of investing, which is far more user-friendly for professionals and individual investors alike, is to invest in stocks of companies which are associated with a certain commodity. This can be buying a company which is associated with the extraction of oil or that are miners for certain precious metals. Whilst it does expose an individual to the price of the underlying commodity, the price of the stock is also influenced by the management of that company. So that's something to bear in mind when investing. Another easy way for investors to gain exposure to commodities is through an ETF or an exchange traded fund, which uses a whole basket of commodities so that an investor can easily gain access to a certain commodity. A commodity ETF normally tracks the price of a commodity or a group of commodity using futures prices, and sometimes it even uses the physical underlying raw material as collateral against that commodity so that investor can benefit from the price of a commodity going up or down. Ultimately, should you as an individual invest in commodities, and it's down to your personal preference, your risk appetite, and also your understanding of the underlying commodity, be that oil or precious metal such as gold or even corn. For example, a precious metal such as gold is seen as a safe haven investment, which investors flock to in time of crises, such as political instability or financial crises, which means that when other assets in a portfolio are normally going down, the price of gold normally increases. This has been a really brief introduction to commodities to understand the raw materials that go into our everyday objects. I hope this has helped to understand how you can buy into commodities, and if you've invested in commodities directly or indirectly through stocks or shares, please let me know in the comments below. I also hope that this video has highlighted to you how the price of a commodity can affect our daily lives and the wider economy, and how this can affect everything that we do, from the items that we buy to if and when we go on holiday. Before you go, please make sure that you like this video and hit that subscribe button, and I'll see you next time.